Hello, trader friends. Welcome to the Tom and Tony Financial and Trading Podcast. Hi, Tom. How are you?
I am doing fantastic, Tony. Good to see you again.
Nice to see you. It's been a very warm summer here in California, and let's catch up. What have you been up to the last month?
It's been a busy month, just personally and trading wise. So I think we're traveling a bit, watching visiting our kids and so forth. And then on the trading side, just continuing to evolve, tweak the plan, and trying to keep making money. So.
Well, that's good. That's good. I mean, we had that scare when a few months ago when we were trading, we had that huge vol spike, and then the market has been on a tear to the upside. Absolutely crazy.
The market's back to normal, doing what the market does. Goes up, goes down. Different assets go up, different assets go down. I think you just you trade what you see, and you keep trying to evolve. And back beginning of August, we had that little vol scare. So hey, shows that you got a little bit of a hole potentially in your plan if you didn't have that accounted for. Now I think I've accounted for that, got that solved, and off and running, just trying to keep making money and trading away. So having a good couple of months since then. So
how everybody says they're weird, but do you know what's weird to me? What's weird to me is that the Fed cut rates and interest rates are back up, and that's absolutely weird.
It is bananas. I'll tell you, I'm pretty heavy into bonds right now. Wow. So I've got my up until yesterday, I have the number one. If you look at like the Tasty Trade allocation thing, I like to look at that and just see how my allocation is. Well, oil was my number one allocation. Oh. So oil's where the majority of my trades are. Doing well in oil. I only had one trade that was a little under pressure because it was a strangle, and oil just kept going up. And then the oil today has reversed itself and completely gone and run away tremendously to the other side. So oil's down 3 points today. But you got all this Middle East tension and stuff going on. So I think that's, been the bid under oil. But I have oil, then ES, and bonds are right there with I'm heavy into bonds. I'm long bonds in a variety of different ways. I do have some strangles, but I'm long bonds. And the funny thing, you mentioned it, is the Fed cuts rates, says they're going to keep cutting, for the foreseeable future, and bonds immediately within a day, bonds have done nothing but go down for a couple weeks now. Since the Fed made that comment, which to me, it makes little sense. There's other geopolitical and other pressures, and I think there's hints that maybe the economy is cooking a little more than it should, and inflation may not be gone. I personally think the Fed jumped the rate a little too much. I think they should have cut 25. There was no reason to cut 50, in my opinion. I think they were bowing to maybe some pressure on the outside. I don't mean to make this political. It may not be political. It just could be, the markets. I'm trying to keep people happy, but there was no reason to cut 50. And now once they cut 50, and they were good, there was even some talk that they might cut another 50 in November and 25 this sounds like another 75 this year. I think that's kind of evaporated.
Yeah, I think so.
With the strong employment numbers that are out. But yeah, you add in the potential longshoreman strike on the East Coast. That could be inflationary. It turned out to be nothing. But, is inflation not there? And is the Fed potentially going to stop cutting, pause, what have you? But yeah, why rates are going up on the long end of the curve, a little bit interesting, especially with the way that, and the dollar's bouncing right now. So you got a little bit of everything going on.
Yeah. I'm a macro fan. And to me, when oil goes down, it means one thing, that economic growth is slowing down. That's one of the reasons I think the oil price goes down. Oil price goes up for various reasons, supply and demand, of course. geopolitical wars, and of course, hot economy will make oil go up. When bonds go down, and you see, I think the Fed has less power than people think. The Fed, I think, the Fed follows the market, and I think the market is telling the Fed that they either made a mistake or cut too much, or that inflation is not under control. Which I think CPI is we're gonna see very. I think we're gonna. Well, this week I think is gonna be benign, and because of the comps for the last year. But I think this will be the last kind CPI report in a while. I think after this one, the next two CPI reports we're gonna see inflation rise. I don't know, and maybe that's what the bond market is seeing, that inflation is not under control, and that is why it's going down. So you said we have to follow what the market. So the market's telling the Fed that they cut too much, right? And oil is saying that they don't see a lot of risk. So you know what they say, MGI, market generated information. Our brains say something, and then the market say another thing. So it's not easy.
And I just trade what the charts are telling in front of me. And if we believe that things are priced in for the most part and valued, I don't know that that's actually the case, but otherwise I think you would, if that was the case, you couldn't guess a direction because it would already be perfectly priced, and it's typically not. But oil dropping today, but it's been on a tear to the upside. We'll see how it goes. But like I said, oil was probably my biggest position until today. I actually took a position off at like 90-some% premium capture. So I took a pretty large winner off. I've got a couple other ones to come off. And then now bonds are up there. I'm just looking at my allocation of bonds, and oil are basically tied right behind ES for my trades. And I have quite a few bond trades, and they're all a little red right now, but I'm okay. I don't think bonds are going back to the lows. I think we're right about where we may end up for a bit here. I can only see bonds trading sideways to higher. I think they're good strangle opportunities. I think they're also good longer term opportunities. So
definitely.
Yeah.
So I think we have a treat for our viewers today. See, one of the most famous hedge fund managers in history, Howard Mark from Oaktree, just launched a video that talked about risk. What does risk mean for him? How does he manage risk? What he thinks about the different types of risk, etc. And I thought it would be really cool if you and I can take what he said in the video, try to apply it to trading, and because what we do is trade more than investing. Of course, we can talk about that. And also, what do you think applies and really does not apply to our styles based on what he said? And he's one of the smartest guys in finance, and I think I told you I watched this video already 7 times. So it is one of the best financial videos that I have seen in a while. In fact, I will post a link to the video below on the video description, so everybody who wants to watch it can watch it. And but I think the most value add for our viewers would be to get your point of view as a risk manager and my point of view of what he says about risk. So
sounds good.
All righty. So the first point that Howard makes is he says that risk is the ultimate test of an investor skill set. He says that when you see a return like 15%, 20%, 5%, the real question we must ask is how much risk did that investor really take to achieve that return? And I think here he's talking about the Sharpe ratio. I don't know. What do you think, though?
Is it the number one thing? I don't know, but I think it's certainly up there. How well you can manage risk. And I've put a couple videos out in the last week or so talking about trading and investing.
Right.
And really, there's two different ways of going about things. And number one, it's investing slower, safer, lower risk. You're looking for 1% a month, 12% a year, 18% a year, something along those lines. 18 even requires some risk, but to get there. Otherwise, you see like trading services or people out there talking about trading and making 1%. Well, 1% is investing. It's not trading. I mean, if you want to make 1% a month or 12% a year, plow your money into an S&P fund or a bond and a target date fund or something like that, and just sit back and let your money grow. You don't need. I mean, you're taking a little risk by being in there, but not a whole lot, and that should be your investing capital. And that should be the majority of your funds. Okay? Right. It depends on your age and what you're doing. For me, it's probably 75% of my
liquid
assets are in investments, and then about 25% is in trading. And then trading, the goal here is not to match the market or just try to beat the market. I'm trying to trade to make significant money. If I wanted to just match the market, I would just go throw it in mutual funds. So in order to beat the markets and generate 18, 20, 25% a year or something along those lines, you have to take risk. And how you manage that risk is going to determine your success rate. And for the most part, I believe that you have to, in order in a trading account to make decent money, you're going to have to take on a decent amount of risk.
Yeah. Definitely.
Can you manage it? Is the key. Can you manage it?
Then Howard comes and says there are 5 different types of a portfolio manager. So, and at the end, he tells us which is his favorite type of portfolio manager, and see what you think. So, manager number 1, let's say let's pretend for all these managers that the market can go up 10% or down 10%. So, manager number 1, on an up market, he makes 10% same as the market. On a down market, down 10%, he also is down 10%. So that's manager number 1. What Howard says here is there's really no skill and no value added. So that's managers practically, you can do the same thing buying SPY, right? Or an index.
There you go. So there's your target date fund or your your SPY or whatever. Yeah, that doesn't take it's not trading. It's just plop your money in there and you don't need to know anything.
No value added.
Right.
No. Manager number 2. On an up market, he's up 20% versus 10 from the market. And on a down market, he's down 20% versus 10% on the market. Howard says here, there's also no value added. The only thing the manager did here is be very aggressive.
Mm-hmm.
What is your take on that?
Yep, 100% agree. There's no real skill involved. You're just going to be aggressive, throwing trades out there, and you're doubling the market up or down, and you're just hoping the market goes up more than it goes down.
Probably this guy was margined, and that's why he was able to double his. Probably. I mean, if we're talking stocks, not derivatives, right? Manager number 3, the market is up 10%, he's up 5%. Market is down 10%, he's down 5%. So he's up half and he's down half. And Howard says also here, no value added, no skill. He just, lower size. Now, managers 4 and 5 are interesting, I think. Manager 4, and here is we may differ from Howard. So manager 4 is up 15, the market is up 10. So he overperformed to the upside.
Mm-hmm.
And when the market was down 10, this manager was down 10. So here is for the first time we see asymmetry of returns. We see overperformance, at least to the upside. So there is value added here, right?
Yep.
And by his skill or something, he was able to only to go down the same percentage as the market when it went down. And the fifth manager is the market was up 10%. This manager was up 10%, same as the market. But when the market was down 10%, he was only down 5%. And he says there's also asymmetry to the returns here. And he matches the market when it goes up, but he overperforms on a down market. So what are your perceptions of managers number 4 and 5?
Yeah, and again, it's different than trading. So this is a little,
Yes.
it's a little different than being a trader.
Right.
This is just trying to actively manage your investments, like a mutual fund manager should be. And they should outperform the market, longer term. And if the market goes south, they should be slightly safer than the market on the downside. Personally, I would think if the market's up 10 and I was able to generate 15%, and the market was down 10 and I was only losing 5, that would be the best of both worlds, as opposed to, because if you can't beat the market when the market's going up, I just don't see a value in trying to manage, unless you're just only trying to manage not to lose.
Yes.
Like you're matching the market on the upside and you're losing less on the downside. Again, from maybe a mutual fund manager or a hedge fund. Okay. I think that's the definition of a hedge fund, is that I would match the market on the upside and I would lose less when the market is going down. So
here I tend to agree with you.
Yeah.
I think asymmetry to the upside as a trader is more important than asymmetry to the downside, although controlling the risk is very important. But for Howard, manager number 5 is the best type of manager. And I think you and I agree that maybe manager number 4 is better, because the manager number 4 has asymmetry to the upside, right?
Right. And that's if you can't perform the market to the upside, I think it's not really worth, from an individual investor standpoint.
Right.
And he might be talking more about, again, professional money managers and so forth, where it makes more sense. They're managing funds and things like that. But if you have to, I believe you have to take some risk to try to outperform to the upside if you want to trade. And the whole reason people are trading is, I want to beat the market. Okay. I want to do something more than just get what the market's going to give me every single day. It doesn't take any skill to match the market. Zero. In my opinion, zero skill, because all you got to do is put it in SPY and match the market. Okay, there's no skill in buying SPY and matching the market. And then if you hedge it properly, potentially on the downside, you can outperform. But if you're a trader, I don't want to match the market. I got to beat the market. I want to earn my 2 to 3% a month, which means I got to take some risk. So I'd like to beat the market more, on the upside of things. And then on the downside, I'm going to take some losses. I just don't want to get creamed on them. So
definitely. Here's another concept from Howard, which is very interesting. He says risk is not volatility. Volatility, Howard says, it's an indicator of the presence of risk, but it's not risk itself. For Howard, risk is just the probability of a loss. How do you see volatility and risk?
Well, I can tell you from experience that volatility is sure as hell a big risk factor, depending on what you're trading. So I can tell you that up until 60 days ago, maybe, but it depends, again, what you're trading, and what are the underlyings that you're trading, and what are you trying to do. So I've got one portfolio of mine, again, split portfolios that I kind of run and share with people. And one's a trading portfolio, higher risk, a lot of futures, taking that risk, and I've made 30, 40, 80% in years in that account, trading account. Investing account, a little bit lower risk, but on August 5th, obviously the trading account got slammed a bit because volatility spiked the markets, things got crazy, but it wasn't a huge delta move, it was a volatility move. And in the investing account, I'm at new all-time highs. And I'm only trading options. I'm not trading mutual funds or anything like that. I'm stock,
Right.
and mostly options on stocks. For the most part, either leaps or naked puts on some things, and maybe some covered calls, things like that. That held up certainly totally well in a volatility spike. In fact, give me volatility, because as a premium seller, I love volatility. So again, I think I don't think for most people out there that are investing, I don't know that volatility is something that they really need to concern themselves with. So I agree there. I think it just depends if you're trading a certain, if you're trading in futures, or you're trading naked in the S&P, things like that, then volatility can certainly be a concern for you. But I think for the average manager, it's probably not. So I probably tend to agree with them on that.
I agree that I like his definition that risk is the probability of a loss.
Mm-hmm.
I also like that volatility is an indicator of the presence of risk. But as a trader, I think the risk is a spike in volatility. To me, that's the big risk. The risk of volatility spiking above 2 standard deviations and hurting our portfolio.
Sure.
That's
if you're a premium seller.
Yes, which you and I are.
Which we are. So for us,
yes,
volatility is
Tom,
risk.
Yeah. For us, the risk is a unexpected volatility spike over what's expected, right?
Exactly. But I do agree with risk is an indicator. So I track a couple different indicators. Number one, I look at VIX. I don't know that I put a lot of stock in VIX, but I look at VIX. But I do look at VIX versus a 3-month VIX to see, is volatility elevated in the near term, number one. And I'm just looking at the VVIX as well. It's pretty elevated. So the VVIX, we know back in August it spiked up. It also spiked up at the beginning of September as well, and now it's spiking up at the beginning of October. It has spiked all at the beginning of every one of the last 3 months. And VIX and VVIX, which is the volatility of the VIX, is elevated right now. So as an indicator, absolutely, I think it's something to pay attention to. Risk is elevated at the present time. VIX itself, I don't even know where. Like I said, I don't pay attention to VIX a whole lot. It's at 25, so it's elevated a tad. It's not super high, but it's definitely elevated. VVIX is elevated. It's as high as it's been on both of those, as both of those spikes got going. So I think there is a lot of short-term volatility in the market, which I think is a very cautionary tale for everybody, especially premium sellers like us. I've been talking to on YouTube and other places with our members that, hey, I'm bullish, but I am cautious, and I've got plenty of hedges on. I'm letting trades come off. I'm still at a decent BP usage, but I'm definitely cautious out there because volatility is elevated.
Yeah. Then Mr. Howard talks about 4 types of risk, and this might be interesting. Risk number 1 is the risk of suffering a loss. I think we all agree that when you take risk, you can lose money.
Right.
Risk number 2, the risk of missing opportunities. So here, the lack of risk in your decisions will make you lose opportunities.
Mm-hmm.
Right? And that's
agree with that.
And me too. And if you don't take risk, you can't do anything in your life, I think. All the meaningful things I've made in my life have happened because I took some sort of risk.
Mm-hmm. Right? Yeah, you can't get ahead in life without taking some amount of risk.
Yeah. You will never, when you see an opportunity present itself, I think you have to take as much risk as you can bear, because that's how you will outperform. Some people can't do it, but everyone that we see who's been successful has taken some amount of risk.
Mm-hmm.
The third type of risk is not taking enough risk. And here maybe I am, once I've made it, I think I've made it financially. So now I think I'm suffering for this type of risk, not taking enough risk. Because I feel, I might at this age, I don't want to take crazy amounts of risk anymore, because I don't want a catastrophic outcome.
Right. Yeah, I think it's definitely, age and lifestyle, related. I mean, the older we get, if I was back in my 20s and 30s, I think I didn't take enough risk in my 20s and 30s. I took more risk in my 40s and 50s than I did in my 20s and 30s. And I did it because I didn't take enough risk back in my 20s and 30s. I was being too conservative on things, and you were doing it, you do what everybody tells you. And I'm talking everything from trading to life. You took the job and you worked the job that was, a steady job. You got the paycheck, you put your money into safe investments that grew. I didn't take enough risk. I wish I had taken more, and it forced me to have to take more in my 40s and 50s, which has paid off. Take a risk of, I own several businesses as you do. And, every time we do that, we take a risk. You take a risk that business doesn't pan out. The same thing with trading is, if I didn't take any risk, I wouldn't be financially where I was today. If all I had was those mutual funds and they were just compounding, I would be doing fine, but I wouldn't be where I am today. I mean, I've made a lot of money trading
Right.
because I've taken maybe too much risk at times. And there's times where I've lost gigantic chunks of money.
Right.
Stuff that would make people extraordinarily ill and panic stricken. Okay. But you know what? It was my trading accounts. It was not my life savings for the most part. But some of these were pretty good sized trading accounts. But I'm okay losing 50% of my trading account right now if I knew that I could quadruple to quintuple that thing in the next 5 years.
Yeah.
So I'm okay with that risk. But if you're not, you shouldn't be trading that way.
Right.
Okay. But for me, I'm okay. I'm okay if I double my money every 2 years and then I give half of it back once and then I double it for the next 3 years in a row. Okay. Yeah, it's not fun, but it's still overall growing at a exponentially higher rate.
Right. Let me tell you a little bit of my story for risk taking. So I started an internet company, I don't know if I told you, before the web, called DataNet, which we put in originally $800,000, sold it for 5.7 million in 5 years, and very profitable when we sold it. EBITDA of $500,000 when we sold it. But this was back in 1992. So $800,000 was a fortune, right?
Mm-hmm.
So I think I took a lot of risk there, because I couldn't even explain to my dad what the hell the internet was, and I was asking him for $800,000, where you could buy 3 luxury homes in La Jolla, California for $800,000.
Yeah.
And let me tell you 2 other times where I missed out on opportunities for not taking risks. So I don't know if I told you, I had the opportunity to invest in Odyssey Golf with a friend of mine, Michael Magerman, and then Odyssey was sold to Callaway Golf for $100 million. So I missed out on a huge return there, or because I thought I knew better than him. I missed out on Ashworth Golf, which was one of the famous golf apparel brands back then, that John Ashworth was kind enough to invite me to invest in his company. All these opportunities came because I was in the golf business, and I didn't take it because I was scared I didn't understand the apparel. And then he sold Ashworth to TaylorMade Adidas for a lot of money. So when I took risk, I was successful. And when I neglected risk, I missed out.
Mm-hmm.
Right. So That's my story.
You miss 100% of the shots you don't take, and
Yep. Unfortunately,
I've done the entrepreneur thing for a long time, and I've started 4 different businesses, and they've it takes a lot of work, and it takes a lot of leap of faith. And my wife is, God bless her, is good. Like, yeah, if you feel like that's the right move, let's go do it. But all of those required risk of safe job, earning money, doing great, or putting your money in here. Let's try something else. Let's try to build a company. I had an internet company once, and I ended up selling it to AOL, not for as much as you would like, and then AOL was gone. So,
right.
But that was back in the in around 90, 91 time as well too. And you got to take. I think you got to take those risks, and I really think some of the people that are trading out there, and for those of you listening, if you're traders on here, are you a trader or are you an investor, and where's your risk profile? And if losing a 20% or 30% of your account or 50% of your account or something, if that makes you, not that you shouldn't hedge and be, trade cautiously, but if you can't do that in your trading account, then you're trading way too big, you're putting too much at risk, and you shouldn't be doing it. You should be doing something safer. But for all those people that lost a little money and now, I'm never doing this again, I think you miss 100% of the shots you don't take. And if there's no risk, there's no reward. And your famous saying of you got to risk it to get the biscuit, you have to go out there.
You have to risk it.
And if you really want to make an impact on yourself and your family's life and everything else, you've got to take some level of risk.
Definitely. Now, the 4th type of risk here, we might have a little controversy with our friend Howard Marks. He says the 4th type of risk is the risk of being forced out at the bottom. And he asks, what is worse? Buying right at the top of the market and then seeing that your stocks decline, or panic selling at the low of COVID on March 2020 and then missing out on the recovery. Howard says selling at the bottom and getting panicked out of your investments is a cardinal sin of investing.
Well, it ranks up there with some of them. However, so a couple things here. So, August 5th, volatility spike. What did most of us do that were trading 112s and just futures? We all got out. Well, not we all. A majority of us got out at the bottom, either on that Monday or so. Some people did not. Right. Those people were sitting there telling us how great their investments looked a week or two later, and they were right back to new all-time highs within a couple of weeks, while we got out at the bottom. However, if you're excited that was your call of, you know what, I'm not going to do anything, even though my plan says I got to get out. Well, sometimes that'll work, and sometimes it does not work. And if you've got my opinion is, if you've got a plan and your plan says get out at a 2x loss, and all of a sudden you're at a 2x or even a 3x loss, you've got to get out. Follow your plan, because the time you don't do that is the time it goes to 7, 8, 10x or something. And on that August 5th too, everybody had the opportunity on August 2nd. Everybody had the opportunity to get out at reasonable losses. And also on Sunday night, August 4th, everybody had a chance to get out at a 2x loss. The only time you got out at 4 or 5 was you ignored 2x. And I'm in that category, so it's all good. Okay. But the time you don't get out at the bottom, then it may not be the bottom.
You're right.
And you've got to have the memory of a goldfish. Okay? And I'm a big, you look at Ted Lasso, if you know the show, and the memory of a goldfish. I am really, really good at that. I don't look at, once I'm out of a trade for a loss, I do not look at that trade ever again. I will not look to see it could have gotten out at the top. I just got out of a strangle for a loss last week. I think I top ticked it to the minute. I think 5 minutes later, it had reversed back under my stop, and then it came all the way back down for a complete winner. And the only reason I know that, not because I was looking, was because I had 2 trades on, and the second one didn't hit the 200x loss, and it came down for a complete winner. And the original one that was hit the 2x, and I stopped out at like a 203% loss, whatever, 2x loss. And within minutes, it was already on its way down, and then volatility came down, the stock came down. You got to get out. I think you have to follow your plan, and if you follow your plan and you don't look back at what could have been, you become a disciplined trader. And the 2 key things you need are discipline and consistency in trading. If you stay disciplined to your plan and you consistently put on trades over and over and over to let the probabilities play out, that will make you the best trader you can be, but you got to follow your plan.
Yeah. Well, here Howard says something very interesting. He says that risk is not quite quantifiable in advance, even after the fact. So that's what you're saying is good. We cannot look back, because even with hindsight, he says it's not even possible to quantify risk. Now, Howard loves this guy, Peter Bernstein, very smart guy. I think he was from Wharton, a professor from Wharton. And Peter says, risk is not knowing what's going to happen. Risk tells us there is a range of outcomes, right? The probability. Mm-hmm. We do not really know where the actual outcome is going to fall within that range. I think we all agree on that. And often, we do not know what that range is. And I think as a trader, we kind of know what the range is, because we trade the curve, right? We trade standard deviations.
Sure.
So
we trade standard deviations, and we trade IV. And obviously when IV, when implied volatility is elevated, there's risk that's being built into something by the markets. The markets are already calculating that there's some level of risk in there, the higher the IV goes. And by the deltas or by the probabilities of our trades, we're getting a sense of how much risk are we taking. But back to your previous comment, is you can't quantify risk before it happens. You can a little bit, but you can't. We assume, based upon the deltas and the IV, that we have an idea of risk. But you can't always tell if an investment was risky after the fact just by looking at the outcome, because a successful outcome, as he mentions, I think in this video, and it could have been a successful outcome from a risky decision. You may have made a risky decision, and you know what? It worked out. You could also have taken a loss from, on the same type of a thing, from an unlucky event. I'm in oil trades, and then all of a sudden, Iran comes out and says, we're going to attack Israel. Okay. Oil goes and shoots up. Well, that's an unlucky event. Do I know ahead of time? Well, there's tension in the Middle East, and oil, maybe slightly elevated, but not to that level. Israel's worried about Lebanon and Gaza and Hezbollah and stuff. And then all of a sudden, here comes Iran from, somewhere in the back, just, getting involved in it. Do you know? And then the one reason I've hated stocks, even though I do trade some, is I still go back to UNH. So United Healthcare, when I believe it was the CFO is at a conference, and he made some offhanded comment about, he's just at a conference, a no-name conference, speaking to a bunch of people, and he says, I think the medical industry's got some tough times ahead for the next couple of months. The stock goes down 20% the next day because this guy makes a comment. You can't predict that kind of comment, and that risk was not built into that trade. So again, sometimes you get a lucky outcome from a risky decision, or a loss comes from an unlucky event as well. Just things happen. You can't always quantify them, and you can't go back and look, could I have done it? No, I wouldn't have done anything any different.
Right. So, that's why I think you're such a smart guy. So you're already touching on stuff that I'm gonna talk in the next few minutes. So to end with Dr. Peter Bernstein, he says, if we knew what was going to happen, there would be no risk. Right?
Mm-hmm.
Now let's talk about tail events. You see, 96% of financial history has occurred within 2 standard deviations. That's what Howard Marks says. And that's where we live, right? Within 2 standard deviations.
Mm-hmm.
But everything interesting in investing has happened outside 2 standard deviations. So tail events happen. We all know the black swan. We know what happened a few months ago.
Mm-hmm.
So 96% of the time, we're sailing in calm waters. But that other small piece of time is when interesting stuff happens.
Mm-hmm.
Then Howard, this is more akin to what we do. He says we have to think probabilistically. And he mentions Dr. Elroy Dimson from the London School of Economics, another very smart guy, who says risk means that more things can happen that will actually happen. I mean, it sounds logical.
Sure.
He says the future should not be viewed as a fixed outcome, but as a range of probabilities. Thus, the probability curve. And that's where we live, right?
Mm-hmm.
We live on a range of probabilities. I think we can agree here with
and 100%. And one of the reasons that I trade 90, 60, 90, 120 days out is, and I believe it was a Tasty Trade study, but I can find it nowhere in Tasty Trade videos. But somebody shared it once. And if I could find this, and maybe we just ask Tom or Tony or somebody at the research team to pull this up. But what they showed was that implied volatility was overstated significantly at 60, 90, and 120 days. And it was understated versus actual volatility at 30, 45, 60 days, which has always been unusual to me, because I know at Tasty 45 days is kind of the sweet spot.
Right.
But that's inside the range where implied volatility is typically less than actual volatility. Where at 90 days, my implied volatility is greater. So based on what you said, to me, I like the longer term, because you're factoring in a more wide range of potential volatility factors that can come in. And most of the time, those wide factors don't all happen. So I'm giving myself an edge, in my opinion, at 90 or 120 days on strangles or naked puts, because most of the time, all of those risk factors don't happen over that time period, and I got paid well to trade those.
The reason we make money trading is because the relationship between realized volatility and implied volatility. Mm-hmm. And what we're saying is that implied volatility is overstated in certain periods of time, and of course, some of the time it's understated, and that's when we can lose money. When realized volatility exceeds implied volatility, right?
Typically, at those shorter time frames, that's when
and gamma increases as well.
Right, 100%.
So here's what I need your level of intelligence, because I had to watch this part of the video a lot of times, and this I think is fascinating. Even when you know the probabilities, that does not mean that you know what's going to happen.
Mm-hmm.
A lot of people think, you were saying this, I placed a 90% probability trade. Why did I lose? Even though you know that's a 90% probability, that doesn't mean you're going to make money. Knowing the probabilities does not eliminate the uncertainty.
Mm-hmm.
That's very important. And here's where I need your brain. This professor says we live in the sample, not the universe. And what does it mean? The universe are all the possible outcomes, and the sample is the actual outcome. And what he explains to make it simple is, let's say we're drawing a lottery. We have a bowl, a glass bowl with lottery tickets. See, all the tickets inside the bowl are the possible outcomes, right? The
Mm-hmm.
sample is the actual ticket that creates the outcome. He says that we live in the sample. We're here, your portfolio P&L, mine is based on the sample.
Mm-hmm.
So,
and I think this goes back to the point I had made, earlier on, and a lot of the way I trade of, we talked about two things that make successful traders, and one was discipline and the other one is consistency. So
yep.
I think this is where you've got to create a larger sample size. And this is where most people get smoked, is they just start trading a strategy and it goes poorly. Okay. Oh, I'm going to trade 0 DTE options today, and I won 2, and then I lose 6. Okay,
Right.
and I quit.
Right.
Okay, I quit in 9 trading days.
Right.
Okay? And I lost all of this money.
That always happens.
I'm going to trade 112s. I get the full book of 8 of them on, and then volatility spikes, and I lose all of that money, all gone. Okay?
Yep.
I've been trading it for 4 years, and I've made an absolute boatload, and I gave some back, but I still have the large majority of this boatload left. You've got to have a large sample size. You can't be putting on discretionary trades, willing here and there, and you've got to stay consistent if you find a strategy that you want to put on. I believe if you're trading, the successful traders out there have a strategy and they use it over and over and over. They're going to take losses, but the sample is the guys that jump into their service and then 3 losses in a row. And now these guys quit the service and they leave and they do whatever. Yet that trader keeps going. He made a bunch of money before. He lost a little bit and he's making a whole bunch more after that. I think there was a time last year. Oh, was it last year? I think I must have lost like 8 strangles or something like that. Or it was like 4 strangles on gold. It was Volmageddon part 1 not April of this year, but April of a year ago. It was Volmageddon. It was gold volatility spiked up, got blown out of like 3 strangles. Okay. All 2x losses, boom, boom, boom. I would say 70% of the people that were trading gold strangles stopped. Never trading that thing again. I kept going, and I had 30 more winners that year. So it's just a matter of you've got to create the universe and not the sample, and not your, or the galaxy or whatever you want to call it. Okay. Versus the sample size. You have to stay consistent and you have to give something a good effort and opportunity to allow the probabilities to play out over time. It's that positive expectancy. If you design a trade with positive expectancy, you just put it on a lot of time up and up. Trade small, trade often, and increase that sample size.
Yep, I agree 200%. He also says that even though many things can happen, only one will happen, which we know that's true.
Mm-hmm.
He does not believe in expected outcomes. So he does not believe, Howard Marks does not believe in the probabilistically weighted value of possible outcomes. He says that people that, they do the formula, they multiply the probability to the outcome. He says that formula is flawed. And if you guys want to know why, I would watch the video, and he has a great example of why. I do not trade that way. I don't think you trade that way too. You do not weigh your probabilistic outcomes, right? No. The risk of an activity doesn't just lie in the activity itself, but in the participant's approach to that activity. I love this statement because trading by itself, trading is not risky. The approach of the participants who trade make it risky. I don't know if we can agree on this. So trading, always when people say, oh, I trade, oh, you take a lot of risk. No. The risk of an activity does not lie in the activity itself, but in the participant's approach to that activity. And I think that's where your skill, the way you trade, etc.
No, I agree 100%. It's all in your what strategy, putting on the right strategy, and how you approach it.
Yep.
Did you hedge? Did you enter at the right time? Did you follow the plan? And was the plan good to begin with? Is it tested? It works. You're continually evolving it. Okay. You can't do something for the first time and expect if you're successful, you're usually lucky. And that's usually where people crank up the size because, this is working pretty good. As soon as I crank up the size, I get slapped back down because it went wrong. Well, it didn't go wrong. It's just that you changed something. You changed the size. You changed what you were doing, or did you what was going on that made that trade more successful? Was there a market condition that you missed that you weren't looking at before, and you just happened to get lucky? It's really having a good quality plan, having the right hedges on, having a good plan, and following that plan to a T.
Here are some concepts I think you're going to love. Howard says risk is hidden. Risk is deceptive. And he says risk is low when investors act prudently. You see? And risk is high when they don't. When an asset is declining in price, it actually becomes less risky. And when an asset appreciates fast, most people would say, oh, that's a great asset. The price is rising. But it actually is the rise of that price is making that asset riskier. So this is counterintuitive. People think that buying, NVIDIA when it's at $1,200 is less risky than if NVIDIA crashes to $300. And
in the investing, even in the trading things, some of these things scare. I mean, I can't trade gold right now because it's too hot. I'm afraid to trade gold, as it's moving up. I'm cautious on the S&P right now. So and even oil, I don't know that I want to chase it. So I get the more things move up, the more I don't like them. I'm very much I'm a trend trader, but I'm also a reversal trader.
Right.
I love underpriced stuff that looks like the good quality stuff that's going down and moving up. In my investing accounts, I just put on some trades, recently. I just bought more NVIDIA. I sold puts on NVIDIA down at 95 when NVIDIA had pulled back. I just sold puts on energy when energy had gone low. So I'm in XLE now, and now it's actually going up too much. But as I like stuff that's been beaten down, that's technically good quality, or even a commodity name like a bonds or an oil. Those are oscillating type things. Those things don't just go like this, like the S&P does over time. Oil goes up, oil goes down. I think if I love to buy something that's at the bottom and going up. The stochastic momentum index, one of my very favorite indicators of all of them. I love when that thing gets overbought or really oversold. Okay, you can trade either way, or the RSI. Either way, they're very similar. I love when something gets to that oversold area. To me, I perceive lower risk the way I trade of selling a put credit spread or something else. I love when those things get to an oversold level and they start to reverse. So I like that stuff.
So we're in agreement here with Howard.
You may bring this up, and I don't know, but he was talking about risk being counterintuitive.
It is
I
counterintuitive.
don't know if that's one of the things you're going to cover, so I don't want to.
It is. Yeah. We have it, but it is counterintuitive. You're actually correct.
People,
we can talk about it. Yeah.
People behave riskier when they think they're safer.
Right.
So when people think they're safe, they take more risk. I can say I'm guilty of that. I don't think I had enough hedging on, and I felt pretty confident. And hey, I'm just murdering this market thing for 4 straight years without any major drawdowns at all.
Right.
And then, I'm going to experiment with a couple extra trades. I loaded up too much. So again, I'm perfect example of that is sometimes when, the markets look safe and you're just winning, that's when you got to start to, step back. If what they say, I think if you remove stop signs, people actually get more cautious.
That's an example that Howard put in the video. So
you're right. That's what he said. I think if you remove stop signs, people get more cautious. So I think it is, and even as you said, the price of an asset can mislead people. So as it's rising, they think it's safer, but it's actually riskier. I 100% agree with that. That is a hallmark of my trading style is as things get high, I don't like them at all.
Yep.
I do not chase.
Because the investors are not acting prudently. And then Howard also talks about Warren Buffett. I think we've all heard the saying that we will find out who's swimming naked when the tide comes in. It means that when the risk event happens is when you really find out how much risk you actually had in your portfolio. So
I agree with that.
Right? We don't know what you really had on until the shit hits the fan.
Exactly.
Now, an investment may be risky, but if we're in a calm or salutary environment, it may look like a safe and winning investment. This is what you were saying, right? So I've never used that word salutary. So I don't know if I even pronounced it correctly. So an investment may look safe for a long time, even years, and the infrequency of a loss can make it appear that the investment is safer than it really is. So people tend to underrate the risk of the real outlier move or the adversity. So I think we're all guilty about this, right? Sure. I mean, we trade for many years, the same trade, nothing happens. So we start thinking this trade is flawless. And then we get overconfident, and then the shit hits the fan.
Right. And you start to do things that you didn't do before, which for me was increasing size, increasing number of trades, not putting on more hedging despite the size, not scaling up on it. So I mean that's certainly one. And then to me the best thing that can happen, and I don't know, for those of you watching here, and if you've lost money, you know it. But to me, losing money is the best thing that can ever happen. Okay, unless you're at the end of the road where I'm going to only be trading for another 30 days or 3 months or something. Right. But if you've got some horizon there, every time I've lost money, every single time, I have made twice as much money in the next year or two. And the reason being is every loss is an opportunity to tweak your strategy, to find a hole, to do something better, and you become even better every single time that it happens. Every loss, and I do a lot of coaching for people, not trading coaching, but trading for like sales or mindset. And one of the things we talk about is having a growth mindset versus a fixed mindset. Growth mindset people view setbacks as an opportunity to get better. Okay. It's not, so we take risks because I know that if something doesn't go right, I will figure out what it was and will be better the next time. Okay. And now I've got something even better in something that's more bulletproof until the next thing happens. Okay, every setback has led to a huge opportunity to the upside, and I think every invention is that way.
Yep.
Thomas Edison's light bulb. I mean, how many times did that guy fail? Okay, and then and then the light bulb. So I think every setback is an opportunity to get even better. And to me, that's what it's all about. If you have a growth mindset, if your setbacks are, oh, I'm going to get into my shell and I'm going to change and I'm just going to go put my money in the S&P.
Yep.
Okay, that's not this. You're missing that growth mindset. You're not learning. What you learned was, I failed. I'm no good. I can't get any better. Okay, you have a fixed mindset that you can't get any better, as opposed to, well, I lost some money. Okay, I figured it out. I solved my problem. And I'm back trading, and I'm making more money now than I was making before, and I've solved another problem. So I think you got to have that growth mindset, not an open mindset, a growth mindset where a setback is an opportunity to learn.
I agree, and also I agree that calm environments makes us lower our guard and take more risk. So I would say everyone out there, if it has been calm, if trading has been easy, if you've made a lot of money, don't lower your guard. In fact, maybe raise it a little bit more, because things are going to change. Maybe not now, but probably soon. Now, they talk about the relationship between risk and the asset quality. And here I think it's more investing than trading. And he says that risk is not a function of the asset quality. They say that people believe high quality assets are safe and low quality assets are risky. And what Howard was saying here, that a high quality asset may be priced too high, so it can become very risky. So what he's actually saying here is that the quality of the asset does not really reflect if the asset is low risk or high risk, but the price we pay for that asset gives it its risk.
Agreed. Yeah.
So he says to be very cautious when you buy something, and what you pay for that asset is actually the risk, not the quality of the asset. You might love Nvidia because it's minting money, but if you overpay for it, maybe that purchase of Nvidia, makes it very risky. And now that Intel is in the dumps, for example, maybe Intel is looked like a low quality investment, but because of the price is so low, maybe it's a low risk investment. So he's just mentioning that investment success does not come from buying good things, but it comes from buying things well, meaning paying low prices for them.
And that's very Warren Buffett like. So it's
very Warren Buffett.
Benjamin Graham like. So I mean, if you believe in value investing, you're looking for high quality names that are trading at a good price, and that's the whole hallmark of value investing. The whole Benjamin Graham approach, really the Warren Buffett approach. You're investing in good quality names at a lower price, at a good price, and that's the goal, which is great for investing. But in trading, you're not really looking at that.
Now let's touch on something how should risk be managed? Here, I also need your brain, because some of these concepts are out there.
Oh, good.
So Howard says we are only going to have one outcome, even though there's a universe of outcomes. There could be many outcomes, but there's only one outcome. Superior investors and superior risk managers have a better sense of the lottery tickets in the bowl, and what proportion of those lottery tickets could be winners and what proportion of those lottery tickets could be losers than other people. So going back to the analogy of we have this glass ball with a lot of tickets, right? Only one ticket's going to come out. and everybody has to live with that outcome. But he says that risk managers understand really the quality of the ticket that they're holding and how many tickets they're holding. So let me see if it makes sense to you. What I'm trying to think here is that we hold better quality tickets, meaning better quality trades, and we have many more tickets, meaning we have many more occurrences and many more trades that will give us a chance to succeed versus other people. He says poor risk managers may only have one ticket and a very low quality ticket. To me, maybe these guys are buying a 5 delta out of the money call on Tesla. To me, that's a low quality ticket. But right, so risk managers, to me, if you're a risk manager trading derivatives, if you have a lot of tickets that can win, and you have a lot of them that if you don't win, you don't lose your shirt. I don't know if my explanation makes sense.
Yeah, no, I think all that. I think it makes sense. It's. I mean, if you're buying options, I mean, I don't love the buying out of the money options. I would prefer to buy something slightly in the money, or maybe slightly out of the money, but not far out of the money options. But you want to buy when that. I think if you're looking at charts or something, you're looking to see, has it come back? Has it hit the 21-day moving average or the 50 or whatever it is? And it's starting to move back up because it's a high quality name. And I'm having a 2-to-1 risk reward ratio if I'm buying options, something along that. You're giving yourself the chance to be, to be successful. And you can make obviously substantial amounts of money when you're buying options. When you're selling options, you're looking more for consistency than making a lot. You're taking a lot of risk on. But I think it's how you set up your trade. And I think understanding what's in the bowl is understanding, well, what's the sector doing?
Yep.
What's going on out there? What's the chart doing? So is the sector moving higher, coming off lows? Is the stock moving, or futures or whatever, moving higher, coming off of lows? Is there anything out there that would present it? What does the volatility, the IV, look like? I think if you put 2 or 3 of those factors together,
yep,
I don't think you need 20. I think people overthink stocks and stuff. I think they over-research investing stuff. I don't think you need to look at that. I mean, if I'm investing, I'm looking low debt, high cash flow, strong growth, earnings growth.
Yep.
Decent PE, growth PE though. I mean, it could a 25 or 30 PE could be, or even a 40 PE could be fine on Nvidia. So it's just a matter of what are you looking for. But I think you just look at those core things that gives you, the ability to hopefully be right or catch the momentum in the right way, giving yourself the best chance to be successful. And you're either going to win or it's not. There's only one outcome.
There's only one outcome, and we're all living in that outcome, right? So
you do that, and I think back to Avengers Endgame. So I'm bringing the Marvel universe in here for people. Okay, when if you watch those movies or whatever, and you think of Doctor Strange was looking at all the potential outcomes, and there was only one potential outcome. But even knowing what that outcome was, making it, getting it to that outcome takes a lot of luck and other factors to come in there. The best thing you can do is to give yourself the best chance to be successful and follow your plan.
Definitely. So we're entering the fourth quarter, Tom, which is good.
Yeah, hopefully everybody's still awake out there. It's a long one today.
It is well, it's only been an hour.
Yeah, it's good. It's all good. It's great stuff today.
It's great stuff, though. Now, because of the existence of risk, things are going to be different than what we expect from time to time. I think we agree with that. How well we are prepared to deal with that when it's different is that will make us successful or not. So we have to be prepared to deal when things are different. And I think that's why you hedge. That's why you do different stuff, right?
Yeah.
Now, on risk management, Howard says that it's very important to know when to be on offense. He also says it's very important to know when to be on defense. And most importantly is how much must we allocate to each approach, which I think that's how you created your trading plan. You have trades that are your offense, your attackers. Then you have some trades that are your defense, your defenders. And I think that over time, with your experience, you know how much to allocate to each of those players, the offensive players and the defensive players. And maybe after a bad event, that allocation changes.
Yeah,
right?
Potentially. And I think you also, the way I interpret that a little bit too is not necessarily trades that are defensive, but having a trade plan that has defensive strategies. What are your stops? What are your stop losses? What do you do? What is your trade plan if it goes south? I think it's having that defensive plan, and not just necessarily defensive trades, but having a plan for if the offense isn't performing, okay, we still have a defensive plan on that particular trade to at least minimize the damage.
Yeah.
So I think from a trading standpoint,
I agree. And here he said something that I think it's very, very aligned to what we do. He says that people ask him, how come you do that trade or that strategy, knowing that that strategy one day will blow up? We all put up trades that we know mathematically they will blow up, right? The math, we know they're going to blow up. But you can mitigate that risk in trading with size and number of occurrences. So even though
having a trade plan and strategy and potentially some hedges if need be. So but if you don't risk it,
you don't get the biscuit.
Get the biscuit. Okay. So do you want to trade with no risk? Well, you're not going to make any money. And people are putting so many flipping hedges on that they can't make any money. So, I'm going to make 20% on my trades, but I'm using 10% of that to hedge. So I'm going to underperform the market. Yeah, you can't do that. You've got to put on trades that require risk.
Yeah. And I think here he says something interesting. He says to take risks that diversify your portfolio. That meaning to trade things that are uncorrelated. I think that's one way to also mitigate risk, right? Trading uncorrelated things.
Sure. Yeah. Like I said, I think I'm almost evenly distributed between oil, S&P 500, and bonds. And sometimes there's gold in the mix there too, or copper or something like that. Maybe there's some slight correlation, but not a ton. And if I look at my investing accounts, okay, now I've got SPY, so I've got the S&P, then I've got oil companies, then I have tech companies, I have energy companies, I have pharmaceutical company. So hopefully you're diversified there. So I don't believe in massive diversification, and I think Warren Buffett has a great quote on. I can't think of the Warren Buffett quote on diversification if I could, but in fact, I don't know. I'll even type it in while I'm talking. But really, it was I don't.
Concentration.
I don't believe that you have to be wildly diversified.
But you do diversify because those hedges that you buy are a diversification from your strategy.
And Warren Buffett's quote is, diversification is protection against ignorance. It makes little sense if you know what you're doing.
Right.
So he's not a big fan of, and what is Apple 50% of his whole account?
Right.
And he just jettisoned most of his Bank of America. So he's even smaller. Apple's still a good chunk, even though I think he moved a little bit out. But you don't have to be wildly diversified.
No.
I think the S&P is diversified enough as it is that if you just wanted to trade SPY or the S&P, I don't even think you need to be in oil and bonds and anything. I don't think you need to do anything. I think if you trade the S&P, you're diversified, you're fine.
I do the same thing. I only trade basically two things, bonds and the SPY. Now, we're at the very end. He says risk is something to be managed and controlled, but not avoided. He says risk avoidance is the worst thing. Risk avoidance equals return avoidance.
Love that.
Right? I love that.
Love that quote. Risk avoidance is return avoidance. 100%. I hope half of my Discord members are listening to that, and the other people on YouTube who want to have 900 hedges on, and the hedging discussions outnumber the trading discussions 10 to 1. Okay.
Risk avoidance equals return avoidance. I love that.
1,000,000%.
Yeah. Maybe that's the big takeaway of today.
I love that. Yeah.
So the bottom line, Howard says, you should not expect to make money without bearing a risk. Mm-hmm. But you should not expect to make money just because you bared a risk. Mm-hmm. So that's interesting, I think.
It is interesting, yeah.
The great challenge in investing is to limit uncertainty and still maintain substantial potential for gains. And a great investor participates in gains when they are available and reduces their losses when they are not. And
I like that one too, because I think part of my trade plan is don't place a trade just because you're bored. Okay?
Right.
So if you don't see a setup out there, sit on your hands. Okay. Cash is a position, as people have said. Okay. It's okay to do nothing. If it's not there, don't take a trade just because you're bored or just because you have buying power.
Yeah. I think everyone has something to teach us. And, especially a smart trader, hedge fund manager like Howard Marks, mm-hmm. Howard was given the job of, I don't remember if it was Goldman or somewhere else. They gave him the junk bond desk, and he never lost money running the junk bond desk, even though he was, buying bonds from the crappiest or shittiest companies in America, mm-hmm. right? So that made him, I think, a very good risk manager and risk taker. And that's I think where he thinks that even a crappy investment, if you buy it cheap enough, it is a low risk investment. But I think there was a lot of good points that he has that we can apply to our trading, and some things we have to implement. And what I take about this is we have to take risk. We have to understand the risk we're taking. We cannot control the outcomes of the risk we're taking, but we have a good idea of the risk we're taking. We mitigate those risks by trading smaller, the trades being smaller, have more number of trades, right, in different expirations, in different strikes. I think that's a way of diversification for us. And we have to keep doing it in order for the numbers to work. So I really enjoyed our discussion.
Yeah, good stuff today. I like it.
I know it was heavy, but I really think that risk is it's an important subject to touch on. And if you don't have a good sensibility or willingness to take risk, you'll never become a good trader. Right.
Yeah. Great stuff. I like it.
Do you have any closing thoughts for us?
Yeah, just again, I think you have to determine whether you're going to be a trader or an investor, and you've got to decide that if I'm going to trade, okay, I have to be willing to take risk. Okay, don't put your whole life savings into it. Trade small, trade often out there, but also you gotta put it out there if you want to try to outperform the market. If you don't, stop all of this trading stuff. Stop watching all this stuff on YouTube, okay, and joining services. Get out and just have a bunch of mutual funds in there and enjoy your life and don't worry about it, okay? However, if the market tanks and you don't have somebody helping you when it comes to it, you're sitting on a bunch of mutual funds too, okay, and you didn't know what you were doing, you're going to end up in trouble. So you got to find people that you believe in, that you trust in. And I'm a big proponent of you have to trade in a group. You have to surround yourself with, or at least surround yourself with other people to be able to bounce ideas off of so you can learn. You've got to have other people that can be a sounding board for your ideas. If you do that, I think you'll be much more successful, but you got to take some risk.
Definitely. Well, everyone, if you want to grow your pile, you have to take risks. And remember, you want to grow your pile, follow Tom King. You want to grow your pile, follow Uncle Tony. And most importantly, remember, you got to risk it to get the biscuit, baby. See you in the next one, guys.
Yeah.